A lot of folks are saying, boy, did we pull some of that 2024 performance and risk assets and stocks and bonds back into the fourth quarter of 2023 when we had that big rally? And if so, what do we do now? So let's kind of go to that issue here with our next guest, Philip Palumbo, founder, CEO, and CIO of Palumbo Wealth Management. Philip, thanks so much for joining us here via Zoom. What's your view of kind of what we saw in the stock and bond markets there in the last 10 weeks or so of 2023 vis-a-vis where we are today?
Yeah, so I'm a buyer of any type of pullback in the markets, but in a very well balanced way. So there's definitely been a forward move in the market, on anticipation of the Fed decreasing rates. I think more than he's going to decrease rates. But overall, there are two key catalysts that I find to be very interesting and why I'm a buyer on dips. Number one is there's going to be an earnings acceleration and growth in this year in 2024 and going into 2025, somewhere around north of 10%. And you have a Fed that's going to be decreasing rates, whether it's 3 cuts, whether it's 6 cuts, or the bottom line is going to be decreasing rates. And we're in an election year. So when you have those three particular situations occurring, you should get a good run overall with the market. The reason why I say balanced is because we can't forget since March of 2022, all the monetary increase in interest rates that we've seen, there's a lagging effect, and we have to be careful of that as investors.
Philip, when you say balanced, what does that mean to you?
So balance means you want to have a diversified portfolio that could protect you if stocks were to go down rapidly. So long duration treasuries, intermediate term duration treasuries, gold and commodities, private equity, private real estate are ways that we diversify clients' portfolios.
All right. So one of the things I like to talk to you about is just kind of asset allocation, because I know a lot of your clients want to have full diversification here. Talk to us about kind of what changes you may recently have made or may consider making in the asset allocation for your clients.
Yeah, so number one, with commodity pullback that we've seen, we added to some energy most recently. Long duration assets such as treasuries, and any type of increase in yields, which I believe we will see in the short term, which is going to create volatility for the equity markets, I would add to long duration. And same thing, like I said before, any type of pullback with overall equity markets and volatility that I think we will see over the next couple, 3 weeks, I want to be a buyer and rebalance into that area specifically. In addition to that, private real estate and private and public REITs are two areas where I do see value here. I think the increase in interest rates have created a decrease in overall values in the commercial real estate market. I think there's blood on the street there. I think it gets worse. And as investors, you want to be there to take advantage of that with fresh capital.
Presumably not office REITs, because I'm not sure I see that thing rebounding for I don't know how many years.
But you got to be careful with that, right? Because there's office REITs in Miami that are actually performing well.
Yeah,
So
that's a good point.
yeah, so it's not every place in the country that's underperforming. But I would agree with you. Areas that we like a lot of multifamily units, we like industrial properties, warehouses. We think those three particular areas will perform well, and you can get some good deals today.
Yeah, I mean, I could just tell you in the great state of New Jersey, anything along the Turnpike, the Parkway, there are just warehouse after warehouse after warehouse, mostly Amazon, but lots of others. So I got to think that's a decent business. All right, let's talk sectors here. It feels like, this Fed is going to bring rates down. That's what the market's been telling you. When you look at the bond market, in that type of environment, what are some of the sectors that you want to have some exposure to?
Yeah, so what we saw actually over the past couple of months when we saw interest rates on the 10-year go from 5 to under 4, right? You saw long duration assets perform best, specifically technology and long duration treasuries. So my view is that it went too far in terms of yields, and we're going to get some volatility there, and you may get a move up here in the short term. So with that move up here in the short term, I think you'll see technology, as we're seeing, start to discount that, and I think you could see value moving into the technology sector. So I am definitely bullish on technology. I believe that artificial intelligence and companies that are really incorporating into their business are going to perform very well, not just in the short term. I'm talking about over the next 3 and 5 years plus. It could be something bigger than the overall internet. Biotech is the other area, right? So biotech is considered a long duration asset. When interest rates went up, right, they're a high cost intensive business. So that's why biotech is off its high, anywhere between 30% or more. Some businesses are off 50% or more. So I think there's value in biotech as we think about that sector going forward. And just one last thing, you barbell that with some quality sectors such as staples and healthcare. And I do think if you barbell a strategy with quality, emerging growth is what we call it, I think you can perform well over time.
Philip, I got to go to one of the names on your list, Disney. It's a stock I followed as an analyst on Wall Street for over 30 years. Boy, I've never seen this story tougher to call here. And I think we're starting to see that with some of these activist investors and, pro Bob Iger, anti Bob Iger, that type of thing. Boy, you got to have some conviction here to be buying Disney or any, old media stock for that matter. But there's certainly so many moving parts for the Walt Disney Company. How are you thinking about this stock?
Yeah, I think you pretty much nailed it. I mean, in my view, though, Bob Iger is an incredible leader and CEO, and 50% of a business doing well or great, it really comes down to management. And having him back in the helm is going to be, I think, tremendous for the business overall. That's number one. Number two, from a technical standpoint, Disney was in a big downtrend, recently broke that downtrend, mainly because activists buying into the business. And I love the idea that value act is involved. So I think with the activists involved, I think with Bob Iger back at the helm, and the focus now getting back into the core of any business that gets back into the core is really important as you think of a business that's looking to turn things around. So getting back into the theme parks and investing 60 billion over the next 10 years is tremendous. It's more about on the content side, it's more about quality over quantity. And then he's going to try to make the streaming business profitable. And I do believe they're on the road to do that eventually.
Yeah, that's an interesting call, and that's again, I think probably one of the real question marks is the streaming business. So there, right. I'm guessing your focus on management is it's uncertain how these companies are going to get the profitability, but we know that Netflix has. So I guess it's a call on Bob Iger and his team.
Yes, absolutely, it is 100%.
All right, Philip, thank you so much for joining us. Philip Palumbo, he is the founder, CEO, and CIO. So I guess his word goes. He's the last word at Palumbo Wealth Management. We appreciate it.